It's Matthew. Yes, they are. What's his name, Matthew?
Champion.
Champion.
I'm gonna have my printer working.
No problem. Come to this site.
Please elaborate on that, please. I know you're team for things, and like judge, yeah, like. Yeah.
I do.
Or like.
Yeah.
Yeah, I think they should say. Yeah. Which sounds like kids out there. I think she thinks the sorry. I do. It's like my solution. It was like big trains and but if you vote, it's oh, do you preach like see her like
Does anyone need a paper copy?
Yes. Anyone else? She's not doing that. It's not, you know, she's not making it. You just smile. Oh, and it's right. I'm not surprised. I got it. Oh. No, looks like you're in luck. I have one more. I have last week, so I'm out. Does anyone want last week's life for practicing on? No. No?
You're the lucky winner, okay. All right, so. I have to hold this thing up again. There we go. Okay, so. Okay. Let's do shareholders' equity. There we go, shareholders' equity. Okay, first multiple choice question just to get warmed up here. Categories of shareholders' equity include all of the following. Which one is actually not? Vijay? Yeah, that one, I was caught by that. What is the account name inside equity? What is the account? Accumulated OCI. Yeah, it's AOCI. You know, it's like retained earnings. That's the accumulated one. But the OCI is the one on the statement of comprehensive income. Okay. First question, Platinum issued 4,000 common shares for 66. They also incurred 1,700 of costs associated that I don't want us to forget about. Let me just get the chat open here. There we go, in case these guys have something to tell me. Okay. When we issue common shares, so let's deal with the issuance first and then the costs. It's a simple journal entry similar to like when you issue debt. We're going to debit cash. And this time we're going to credit common shares for 66. Now the issuance costs. Let's say we paid cash, 1,700 for issuance. Oops, 1,700. I need a debit. What is the account I need to debit? Anyone want to take a shot at it? Vijay, I can see that you're trying to. Yeah, it would be. What I wanted Vijay to do was to get the perfect wrong answer, but no, he went and got the right answer. So thanks a lot, Vijay. Seriously, most people will tell me, issuance expense. So I'm just going to put this in here so I can cross it out. That's my bad answer. Vijay was right. It is common shares. So we are in shareholders' equity. The transactions we're doing here are capital transactions. Expenses are related to operations. When we do capital transactions, we don't touch expense. And for that matter, we don't touch gains or losses either. So we're not going to be using those accounts. Okay, if we're in the shareholders' equity chapter, don't be using expenses, gains, or losses anywhere. Yeah, I think anywhere. Yes, Nathan.
Would it be wrong to combine that into one?
No, it wouldn't be wrong. No. Yeah, you could have just given me 64.3. That would be perfectly fine. As long as the journal entries are on the same date, you're welcome to combine them or split them out. Like, I should be able to read them and see that what you've done is right. But don't combine journal entries that go on different dates. That's the only caution. Okay, so key takeaway. Issuance costs netted. Against share capital, against common shares. Do not use an expense account, since they are capital transactions. Okay. Next, multiple choice question. Common shares of a private company that are issued in exchange for non-monetary items. So let's say I'm buying equipment, and instead of paying cash, I'm giving shares in my private company. How do we decide what the transaction price is of that transaction we're engaging? You're giving me the equipment, or whatever I said, land, equipment, and I'm giving you shares. How do we decide what the transaction value is? Is it A, B, C, or D? Which one of those sounds like an accounting standard speaking? Luca?
See,
Yeah, see, that's good. He's starting to get to the feel of how accounting standards are written, the more reliable. That's a good thing. Like, that just sounds like them. So either whatever it is that you're receiving or the fair value of the shares. Usually, if the shares are traded, then the fair value of the shares is something we can access with more precision, right? Whereas an appraisal is always a fuzzy number. It's like what the expert thinks the thing would sell for if there was a buyer. But often these things, the actual price a real buyer would pay will vary from it. Okay, so just as a sidebar here, which types of corporations issue common shares? Is it publicly traded only? Is it some private only? Is it all public and some private, or all public and all private? Nathan?
all in all.
Thank you. Thank you. It's all and all. If it's a corporation, and I'm talking like a company, I'm not talking like a not-for-profit corporation, but those things all have shares. Otherwise, how would we know who owns it? What I don't want to see is someone to say, well, what they will often say is, well, they don't have an earnings per share. Private companies don't have earnings per share because they don't have shares. And I'm like, oh God, please don't tell people you're from the University of Guelph when you say that. Just don't embarrass the rest of us. Because we all know that corporations all have common shares. They might not have pref, right? They don't have to issue pref, but they do have to issue common shares. So private and public companies have common shares. Okay. Let's do Parker Corp. Parker Corp's charter authorizes the issuance of 1 million common and 500,000 pref shares that have a dividend rate of $6 per share per year. The following transactions involving share issues were completed. Assume Parker follows IFRS and each transaction is independent. Okay. So Parker issues 4,200 common shares for machinery. Common shares for machinery. That's this situation, right? That's that one. The machinery had been appraised at 74.5 and the seller's carrying amount was 58.6. So the value of the machinery, should I put 74.5 or 58.6 there? Which one should I use? Sabine. Sorry? The seller's carrying amount, but that could have been from 3 years ago when the seller bought it. Do you want to change your position, Sabine? Right, good answer. 74.5. Because we're assuming it had been appraised recently, right? The carrying amount, it could be such an old value. All right. The common share's most recent market price is $18 a share, so if I multiply that out, 18 times 4,200 shares, it is 75.6. Okay. Which one of these two values would you use for your journal entry? Nathan.
The share price, the share value.
Okay, why the share value?
Like before, it's like more easily like recognized, more widely recognized.
Yeah, I think we could say it's more reliable. So we'll use this one. But you know, they didn't say that the shares are publicly traded. They kind of allude to it by saying that they follow IFRS, but private companies can choose to follow IFRS. But I mean, it's not crystal clear here. If it's publicly traded, then for sure, I'm going with share value. If it's not publicly traded, and like the most recent market price 3 years ago when they added a third owner, well, then that's not very relevant, right? So it is contextual, but let's just assume that this is the more reliable. Now, I think in the textbook solutions, they say they use the 74.5 and their rationale is that it's the lower of. Well, I disagree and I'm right. I mean, the standard says the more reliable, right? It doesn't say the lesser of. So I just disagree and they're wrong. So sometimes that happens. We have disagreements. I'm very confident that I am right. Because it happened because, you know, when I'm doing these things, I don't look at the solution and then a student comes to me and says, well, why is your answer different? It's like, huh, did I mess something up? But no, I know I didn't. So we're going to record. You get into the habit of doing debit cash credit shares, but remember, if I give you a shares for asset thing, don't forget to, put the name of the asset in your account. So machinery or equipment or fixed assets or PPE. Machinery and common shares. So 75.6. Okay, the board of directors declared a $6 dividend on both the 17,000 outstanding common and the 40,000 outstanding pref. So 6 times 17, that is 102. And 6 times 40 is 240. What's the account that I'm going to use to record the fact that dividends are declared? What's my debit account? Or my credit? Ethan, do you want to take a shot? Definitely not. Okay. Okay, Luca.
Is the credit.
It would be dividends payable, right? Because we haven't paid. Jens, do you want to give me the debit? Sorry? You could use just dividends, yeah. How did I do it in the solution? Let me just be consistent with myself. I mean, I've given you 3 lines here. I could have gone with 4. How did I do it? Okay, so I did dividends pref. And dividends common. And then I put the dividends together as the payable. I just combined them. You could do it the other way, put dividends and put the amount and then payable to the common and pref, or you could use a 4-line journal entry. Doesn't, I'm not that fussed about it. So 102, 240, and then that adds to 342. What other account name could I use other than dividends? This is the account that I would use. Yes, Nate.
It's declared.
You could say dividends declared, okay, either one. I want another account. Like a different account, it doesn't have the word dividends in it. What do the dividends come out of? Yes. It is retained earnings, yeah. They come out of retained earnings. That's kind of where they ultimately end up. So, like, I personally prefer retained earnings. I will totally mark you right if you write dividends. So if that's easier for you, then it's fine. Okay, next independent situation. So what they're saying is this is for a lump sum. They're already saying to me with my accounting mindset, are they talking about a bundled sale? The common shares had been selling at 13 and the pref at 80. So I think, yeah, I think they're giving me a discount on the bundle. Do you remember how we handle that in 3330 for RevRec when you sell like phone plus 2 years phone plan? Yes, Luca.
Was they calculate the percentage of the total
Exactly. It's called the relative fair value approach or the proportionate approach. So we're going to calculate what it would have cost if they were paying full value. So the fair value of the common is 2,500 shares at 13, which is 32.5. And the pref 1,300 at 80, 96. So in total, if sold separately, they would have had to pay 128.5. Instead, they're only paying 125. So now we're going to use the proportions out of 128.5 to allocate the 125. So this is going to be 32,500 over 128.5 times 125,000. This one will be 96 over 128.5 times 125. It works out to 31,615 and 93,385. So we'd make our journal entry using those numbers. I don't know why I didn't put a frame in there for a journal entry. I should probably fix it. Fix it for next time. Okay. The other way you could receive the information is when you don't have information about all the things being bundled together. So here we have a bundled sale and shares for non-monetary, right? It's not shares for cash. And what we don't have in this case, unlike the previous independent situation, we don't have a pref share value. So maybe the pref shares just don't trade. So we don't have the current value for them. In that case, we're gonna take the appraised value of the furniture because that's the best information we have. It's the most reliable of 36, and we have to split it between common and pref. Our common, we know, are worth 14 times 2,200. 30,800. So we kind of back into the value of the pressures at 5,200. Do you guys remember from your RevRec what this approach is called? I mean, the name of it is not that important, but yes.
Is it residual value?
It is the residual approach. Good. Abby.
Ali usually sits here, I'm
Emily.
Ali's going today.
She's usually on the other side.
Yeah.
You know, it's just confusing me. Okay. So it's called the residual. You know, it's not that important to me. It's not the name of the approach that's important. It's just that you know that these approaches are out there and how to use them. And if someone said it to you, oh, just use the RFV. I want you to know exactly what that means. This is the preferred approach. If we can get values, we'd far prefer to use the RFV approach. And the standards say that, right? There's a hierarchy. This is at the top of the hierarchy. This is like next best. So our journal entry, I did put a frame here. We've got the values. Why don't you do the journal entry? Just because it's good practice to like work that out. I mean, all the numbers are there. It's just the accounts and the debits and credits that I want you to do. Just give it a shot. Okay, so what did you debit? Luca.
Furniture?
Yeah. I'm just gonna put furniture and fixtures for the 36,000. So then it just clicks right in, right? Okay, so the others have to be credits. Credit common shares and credit pref shares. 30,800 and 5,200. Remember I said how the standards collapse? Once you start to know them really well, you see how there's so much interlinkage. So just this hierarchy that we're using in common shares, it's nothing new. Same hierarchy you use in RevRec. You see more and more of that as we go through. Okay, online assignment 2. So Chadwick has 450,000 common shares outstanding. They declare a 6% stock dividend when the share's fair value is $30 per share, carrying value 18. Prepare the journal entries for both the date of declaration and the date of distribution. First, why would a company issue a stock dividend instead of a cash dividend? Do they do stock dividends often? Like, what do you hear about more often? A cash dividend or a stock dividend? You definitely hear about cash dividends much more often. So, why are stock dividends less popular? Why would that be? What are they saying when they do a stock dividend instead of a cash dividend? Can you tell me your name again?
Mitchell.
Oh, Mitchell. Okay, Mitchell. It actually does lower the share value. That's true. That's not a good thing, right? I mean, okay, wait a minute. It lowers the share value, but there are more shares. Right? And actually, it lowers it by exactly the amount that the shares go up, so that the total value of the company is unchanged. Right? So it's kind of like it's a what's the point dividend. But the more concerning reason why they would do this is because, Luca,
Don't have the cash or the cash equivalents to.
short of cash. Not a good thing to report to the market, right? So they try to avoid that. They really try hard if they've established a pattern of paying cash dividends. If they actually move to a stock dividend, that's a signal. Not a good signal. So, I mean, not in every single case, but I can't think of a good reason, so in most cases, that's why, so not good. Yes,
Is the stock usually plummet when that happens?
pardon?
Does the stock usually like plummet when that happens?
It doesn't plummet, it just kind of goes down by the amount of the dividend, so that if you give a 10% dividend, the value of the shares will probably go down by about 9%, right? So that it perfectly offsets.
Out, they know that. Cash returns.
It is, yeah. The companies they can't hide it anymore. So, it's getting more serious. Are stock dividends good for investors? So we don't have the cash to give you a cash dividend, but is it good to then, I mean, since we don't have the cash, is it good then to at least get a stock dividend? Anyone? No, it's not. Why do they do it? They do it because some investors might think at least I got a dividend, but when you really look at it, it's not good for investors, and sophisticated investors know this. So it's no. First problem. No change in the value of your holdings, right? You have more shares, but every share is worth less. You didn't get anything. No change in value of holdings. I mean, that's not.
Miss, I
You
do
could
want to
say-
interrupt, but your camera is blurry online.
Okay, sure. What's your question?
Says Blair.
Oh, it got blurry. Oh, I leaned on it again. Okay. There we go.
Thank you.
Okay. Oh. Okay, it's good again. All right. Thanks for letting me know. And like, you guys can always tell me too. I guess technically if you pay a cash dividend, the value of the share should go down too, right? Because you're removing something from the company. So let's just nix that, but just know that there's no change in the value of holdings, and think of that in context of the next thing I'm going to tell you. When you get a stock dividend, you did receive a dividend. And you know what you then have to do? You have to pay tax. Yep. No cash received for dividend, but must pay tax. Raise cash elsewhere. So didn't change the value of your holdings. You got nothing except a tax bill. You got a tax bill. But that's the net result. And now you're gonna have to raise cash from your job or by selling some shares to pay that. I mean, that's not a good thing, right? It's not a good thing. Another problem, so that's like a practical, real, we can grasp that problem. Another bad thing about it. Let's do the journal entries and then that'll lead into the other bad thing about it. Dividends. When we declare the stock dividend, we could say debit stock dividend, or we could use my favorite account, retained earnings, right? Because that's ultimately where it comes from. On the credit side, well, they're going to issue common shares, right? So I'm going to say common shares distributable. And then when they actually distribute, then I'll pull them out of common shares distributable, and now they're actually out there. So they're just plain common shares at that point. In this case, well, let's just look at that before we fill in the amount. What you see happening there, if we cancel out these, we moved within our shareholders equity section, we moved some money or some amounts out of retained earnings into common shares. Not a good direction. Shifted capital from retained earnings, which is earned capital, to common shares, which is contributed capital. Why is that bad? It's bad because of the difference in ease of distribution of capital. If you want to distribute retained earnings to your shareholders, what do you have to do? Luca?
Like cash dividends?
Yep. Yeah, the board meets and they declare a cash dividend. As soon as the board declares it, it's a legal liability and you can pay it, right? Easy to distribute. Can you distribute common shares? Not a return on capital, but a return of capital. That's not done very often because it's difficult to do. Creditors are supposed to have preference over shareholders. So if you want to return capital to shareholders, like give them their, I'm just going to use air quotes, give them their principal back. Well, the lenders have reason to have a problem with that, right? They want their principal back before the common shareholders get their share value back. That's a problem. You actually need to go to court and get approval from a judge who's probably going to take into account the opinions of your creditors. It's not so easy. Difficult to distribute. Now, most companies cannot, they don't actually dividend out their retained earnings down to zero. So this becomes a little bit more conceptual, but conceptually it's not good. Just another example that ties into that. If you have like a multinational corporation and they're setting up a new subsidiary in Brazil or Indonesia or the UK, you know how much money they will put in as share capital to their subsidiary? $100. Why? Because, you know, they can get the company to declare a dividend and repatriate the money back to the parent company in Canada. But you try to get the share capital out that you originally put in there, I mean, you could have problems. The courts might say no. So they keep their share values for their subs very, very low because they want to be able to pull the capital back, right? They don't want to put a lot of money. They don't want to put millions over there that they can never get back. So instead, they use something like an intercompany loan to provide capital, because a loan, the company can always get paid back for, right? It's just pay me back my loan. They don't have high share values. They won't put a lot of money into common shares, just a very nominal amount. Because it's a problem. So this shift, not a good shift. We don't like stock dividends. Not a good thing. They only do it because then they can say they didn't stop their dividends. When in fact, stopping their dividend would actually be better for their shareholders than giving them a stock dividend. But you know, like the wider mindset of people is that, well, at least I got something. Yeah, what you got is a tax bill. That is all you got. You really only got a tax bill. Okay. Let's look at online assignment 3. Kindy Corp has 185,000 common share. Oh, we didn't do the amount. Okay, when you have a stock dividend, people are like, okay, I get stock dividends, I know how to do it. But then you get into, okay, so what's the amount? 6%. 6% of what? What is the 6% of? Emily.
The 450,000 shares outstanding.
Yes, 6% of the total shares outstanding, you get a dividend of that amount. So now we have 6% times 450,000 shares is some number of shares, but I need a dollar value. Okay, so am I going to multiply by 18 or 30? Yes. Yeah, it's the fair value. So you take the number of shares times the fair value. So do not take 6% of the value that you see sitting in common shares on the books, right? That would be wrong because that's the carrying value. We need the fair value. What is the share price now? So we're issuing 6 times 45 is 9 times 3. Let's say 27,000 shares. I think that would be the right number. 27,000 shares. And we value them at $30 per share, which is $8.10. Okay. Online assignment 3. This is a split. So Kindy has 185,000 common shares outstanding with a carrying value of 20. They declare a 4-for-1 stock split. How many shares are outstanding after the split? 4-for-1. How would you calculate it? Luca? Yeah, it's just exactly as it sounds, 185,000 times 4, which is 740,000 shares. After. What's the carrying value per share after the split? This is also very intuitive, Luca. Yeah. 20 per share divided by 4. $5 per share. What is the total carrying value after the split? Well, it's 740,000 shares times $5 per share. 3.7 million. What was the carrying value before the split? 3.7 million. That's the same as 185 times 20, right? So in this case, you can see that nothing changed. Nothing changed. So what journal entry is necessary to record the split? No entry. Because the value of the shares, or the carrying value of the shares, that's what shows on the books, right? No change in the total carrying value of the shares, it's just more shares are carrying a smaller value each. Okay, what's a better signal? A stock split or a reverse stock split, where like you could go 4 for 1 would be a reverse stock split. Give in 4 shares and I give you 1. Which is a better signal in the market? A split or a reverse split? Why would a company do a split or a reverse split, Emily?
A split is like, it means the price of the stock is getting too high. So they wanna keep more expensive, so you don't get an investment stock.
Yes. So with a stock split, the price is getting too high. Is that a good thing or a bad thing? That's a good thing. A reverse split often happens when like, oh my God, I'm getting close to like penny stock territory. Let me do a reverse split so I stay in like, you know, dignified territory. I'm not at the bottom of the barrel. Okay, so yeah, a stock split, good signal. A reverse stock split, okay, let's talk about them, results in a decrease in the number of shares outstanding. That's right, right? What doesn't change? Retained earnings, par value per share, market value per share, or none of those things changes? Which one doesn't change? See how 2 of them say per share? Does it make sense to you that after a reverse stock split, the per share is the same? No. I mean, we didn't touch retained earnings, did we? We had no entry. Retained earnings didn't change. Retained earnings changes in a stock dividend, but not in a split. Okay. So that's the end of splits and reverse splits. Let's get into share redemptions. Share issuances are easy. Well, they're more straightforward. We just issue the shares at the market price. All the time we issue the shares at the market price. For share redemptions, you know, it's like the buyback of the bonds. Remember, we had to go to all that trouble to figure out what is the book value or the carrying value of the bond on that date. And we had to pull that amount out. Well, similarly, for redemptions, like when you buy back your shares, what comes out of the common shares account or the pref shares account is the carrying value of the share, not the value that you paid. Whereas when you issue shares, you just issue shares at the price, and the carrying value of the ones you issued previously is totally irrelevant. It's not irrelevant for redemptions. So when shares are redeemed at an amount greater than their assigned value, so like we issued them for $10 a share and now we're redeeming them for $12 per share. Okay, we got 10, and to buy them back we need to pay 12. What do we do with that $2 excess over their book value? What do we do? Where is it first allocated? Does anyone know from the exciting content video? First it goes against contributed surplus of the same class of shares. And then it goes against retained earnings if there's not enough in there to absorb it. Gain on share redemption. Those two words should not go together because gain is like operating. Share redemption, that's capital transaction. Yes, Mitchell. Yes, thank you, Mitchell. Okay, other comprehensive income. Not income. Capital transaction. When we have losses, which is what we sort of have here, right? They gave us 10, we bought back for 12. That's like a loss to the corporation. We never record loss. We either absorb the loss through contributed surplus, which is where you put previously earned, air quotes, gains, or you take it out of retained earnings. We never touch the income statement. Never touch the income statement with any of these things. So let's look at Kent. So first thing that happened, the company is granted a charter. So they go to the lawyer and they write a charter authorizing them to issue 150,000 pref and an unlimited number of common. What's the journal entry for that? No entry, because nothing's happened yet. It's just that we can issue up to 150,000 pref and as many common as we want, but we haven't yet. So no entry for the granting the charter. Then the founders are issued 10,000 common for land valued by the board at 210 based on an independent valuation. Okay, so when the company starts up, like what value could the shares possibly have? We have to use the appraised value. Like the shares can't be trading because they haven't been issued. You have to use the appraised value here. So for this one, and they gave us this thing which made us feel better too, based on an independent valuation. So what would my journal entry be here? Yes, Nathan.
Debit to land, credit to common shares.
Yeah. Debit to land and a credit to common shares. Or the 210. Sold 1,500 pref for cash at 110 per share. Anyone want to give me a journal entry for that? You don't have to tell me the amount, but you can give me the accounts, right? Vision. Yeah, debit pref shares and credit cash. Wait, sorry, debit cash. Credit pref shares. You got me. So it's 15,200 shares times 110 per share. That amount is 1672. These were both issuing shares, issuing new shares. It's easy. What did you get for them? It's easy. This is where it gets a bit more tricky. Repurchased and canceled 300 outstanding pref shares for cash at $100 per share. You know, I want to do these transactions as we're going. Yeah, so Sorry, I forgot to do that. Transaction number 1, which was the issuance of 150,000 pref and unlimited common. On this little frame here, I've got the number authorized, the number outstanding, the per share value, and the carrying amount. So for the first transaction, all we have is the number authorized, right? Because this was the charter. We didn't issue any, so none are outstanding. And common, for number 1, we have unlimited. All right, for the second entry, they were issued common shares. Of course, that one goes first because the company doesn't really exist until it has common shares. Like, it's not like executed into a company until it has common shares, because that's the owners. That's why pref shares never go first. It has to be common first. Okay. So they did issue some common shares. Doesn't change the number authorized, but there are 10,000 shares outstanding. And the amount is 210,000. For the pref shares, it was transaction number 3. Outstanding is 15.2. Per share value was 110. And the amount is 1672. Everybody okay with tracking that? It's just the same information, just in a little table. Okay, now we get to the buyback. Repurchased and canceled 3,000 outstanding pref shares for cash at $100 per share. So this is the thing that I find students have a really hard time remembering. When you do a repurchase or a buyback, you take it out of the share account at its carrying value. So I'm going to debit preferred shares, not at $100 per share. That's going to be my cash amount, yeah, but it's not going to be what comes out of preferred shares. What comes out of preferred shares is going to be at my per share value of 110. My carrying value. Book value. So that's going to be 3,000 shares times 110 per share carrying value, which is 330,000. I do pay cash, but it's 3,000 shares times $100 per share. Awesome, I got 330, and now I can buy them back for 300. I need a credit of 30,000. It's like a gain. What's an equity account that sounds like it would be a good place for gains to go? Pigeon? Yeah, contributed surplus. That sounds gainy, doesn't it? Surplus. Don't put it, no gain on redemption of shares, like capital transaction. Contributed surplus. That's where the 30 goes. Okay, next one. I like this one. Paid 85 in dividends that were declared in the previous period. So what accounts will be affected if they were declared in the previous period? Luca?
Dividends payable in cash.
Yeah, just dividends payable in cash. Just pay attention. Gotta stay awake. These are not new dividends. They were already declared. And now we're just paying them out. So they must have set up a dividends payable account. 85. I forgot to post my preferred shares. So in my preferred shares, I think this is number 4. We bought back 3,000. And we bought them back at 110. Which is why we're gonna deduct 330.
You just move it.
Yeah, I'll move it down a little bit. But they said they repurchased and canceled 3,000 shares. When they cancel them, they're no longer authorized to be issued. So this is actually going to go down by 3,000 as well. They don't always cancel them. So you have to look and see if they were canceled. Everybody good? All right. Repurchased for cash and canceled 500 of the outstanding common shares issued in item 2 above, okay? And they paid 49. So initially, the common shares were issued up here. Now they're buying back 500. So we know we're going to debit common shares because we're going to de-recognize common shares because we're buying them back. But the value, we need to know what was the average carrying value of those shares because that's the value at which they come out of common shares. I didn't calculate it, but I can see what it is. It's $21 per share, right? I just did 210 over 10,000 shares. So that's my per share value. That's the book value per share. $210 over 10 is 21. So that is a critical value. Good, we have time. So it's 500 shares times book value or carrying value of $21 per share. That is 10,500. But I had to pay cash of $49 a share. $24,500. I need more debits. I need actually a debit of 14,000. It's like a loss because I originally issued the shares, those 500, I issued them for 10,500. And now I went and bought them back and I had to pay a lot more money to buy them back. Like from the corporation's perspective, it's sort of got a loss, right? Okay, so where do losses get posted to? Because they don't go to the income statement. We're not going to call it a loss, Vigent. Debit to. It can only go to contributed surplus if that class of shares has previously recorded contributed surplus. And it hasn't, right? Because that contributed surplus is related to pref shares. We don't have any contributed surplus related to common because this is every transaction since the company started. So there was nothing. So if there's no contributed surplus, then where do we put the losses? Vision. Retained earnings. Yeah. So that debit is going to go against retained earnings. So now I'm going to post this. Is it it's number 6. I have 500 coming out of there at 21. So I'm taking out 10,500. Okay. Last transaction. Issued 2,000 pref at 99. Gotta love the issuances because they're easy. Debit cash, credit pref. It's the buybacks that are challenging, that we have to do all the tracking for. You wanna issue new shares, just keep issuing them and write down whatever, the transaction value is whatever amount that you received for those shares. $2,000 shares times 99, 198. So I'm going to. This is the last transaction, number 7, yep. Outstanding plus 2,000 more. Per share value was 99. So I'm adding in 198. Now I'm ready to sum everything up. So 150,000 minus 3 is 147. Number outstanding is 14,2. And the amount, I'm not gonna try that one in my head, it's 1540. I mean, they canceled 500, right? But like unlimited minus 500 is still unlimited. So 9,500 shares outstanding and the amount is 195. Okay, so let's do a little partial balance sheet for just the shareholders' equity section. I ask you to do this on the exam. There's usually a bonus mark there for giving me a good title, which would be Kent Corp. And what is it? You could say partial balance sheet or shareholders' equity section. And then the date. Would I put for the year ended or at the year end? It's at, yeah, because this is a balance sheet, right? And you know what? They didn't actually tell us the year end, so I'm just gonna say at the year end. I don't know what it is. Okay, so that's one mark. With our contributed or paid in capital. The way we order them, you know the conventional order, right? Pref shares go first, then common. What's the third one that goes after common? What's the third account? Well, let's do the pref and the common. The amounts are 1540. 199.5. One mark, one mark. You tell me the amount authorized. 147,000 authorized. Half mark. 14,2 issued and outstanding. Half mark. On this one, unlimited authorized. Half mark. 9,500 issued and outstanding. Half mark. It's marks dense, right? It's very dense with marks. The other account that belongs in paid in capital is an account we used in here. Contributed surplus. It goes up under the paid in capital subtotal. So you'd have to look back through your journal entries. When did I touch contributed surplus? Oh, only once. Good. So it's 30,000 credit. Okay, so credit, all of these balances are credit balances, so I don't have to put it in brackets or anything, 1 mark. Total paid in capital, this is our contributed. This next one is gonna be our earned capital. If you give me that subtotal, which is 1769,500, half mark. And then what is the earned capital account that this company has? It's not hard, think of that. Okay, Lily. It is retained earnings. Okay, let's just go back, cause like. Oh, there we go. Assuming that the company has retained earnings from operations of 1032. Prepare the shareholders' equity section of its balance sheet after considering all the transactions above. So our dividends are not gonna touch it because we haven't touched retained earnings. The only thing other than the retained earnings from operations, which I guess is their profits, would be this hit to retained earnings when we did the buyback and we had to pay much more than we initially issued for. So it's going to be 1032 credit plus 14,000 debit. Which is 1018. This is journal entry number 6. And this was given. So that I would probably. I'd probably give 2 marks for this. Because it's hard to get this. And for knowing that it's retained earnings and giving me the given amount, that would be worth 1 and another mark for this adjustment. And then a half mark for totaling it. Total shareholders' equity, 2787,500. Very marked dense. Usually for the shareholders' equity question. Oh, that's what, hold on 1 second. To drop all the people online. There we go. Okay. All right. Okay. So yeah, usually for the exams, I either do this. Ask you to put together a shareholders equity section. Honestly, it's usually an absolute freaking nightmare to mark that. So 2 out of 3 times, I'll ask for journal entries and not shareholders equity sections, because I really lose my mind trying to deal with these things because people just are so all over the place and it's like, oh my God. But yeah, it could be this or that. I don't know what I did back in January when I set up this exam.
Could it be both?
Could it be both? Probably not, because it's just too many marks. You know? But I could ask you for. What's the retained earnings balance at the end of the year? You know, so do the journal entries and tell me what you think the retained, so then. I'd need to see that you know. To take like the retained earnings coming from operations and all the hits that we had from the buybacks, right? Because that's the only place that the hits come from, buybacks. And the contributed surplus. the gains and the losses on buybacks. That's the only place they come from. So I could ask that. But I wouldn't like doing this and doing this. It's just too many marks and there's not enough time. It's the time. Cause I only have 80 minutes. Did you see I posted? They gave me the rooms. So we're locked. Yeah, that's good. It takes them a long time and there's grumbling. Well, why does she need extra time? It's like, because I have extra long midterms, okay? Because I do. I'm trying to help the students. Would that be okay? The other one's optional. Yeah, they don't like it too much, but you know, I just keep smiling at them and saying, yeah, that's good for students. Okay. Why is the distinction between paid in capital and retained earnings important? Remember, we've talked about this when we talked about stock dividends. Contributed, earned. What is the key distinction that makes earned better? Easy to distribute. Declare a dividend. Difficult to distribute. I don't really like this next question. What time is it? 2:12, okay. How would the repurchase of pref shares differ if the pref shares were retractable? It's kind of a weird way of asking the question. What are retractable shares? Retractable shares are shares where the holder can elect to force a buyback under certain conditions. So you just think of a holder. I gave you my money, now I'm retracting, I'm pulling it back. So the share agreement could be written like, after 3 years, we have the right to force a buyback at a certain price. You know, under certain conditions, we, the shareholders, have the right to force a buyback, and the company has to buy back the pref shares. So of course, if they were retractable, they would have certain conditions and certain share prices at which you could force the buyback, right? So then the buyback would match the conditions in the share contract. So, you know, it's a weird question. So then timing and pricing. Timing and pricing may differ from the non-retractable. Similarly, they ask about redeemable. That's when issuer has the right to buy back under certain conditions. It may be that the buyback price that you originally put into the share contract value is lower than the market price. So then you're not going to go in the market and buy the shares. You're going to exercise your rights under the redemption contract and buy them back, force a buyback, force the holders to give you back their shares at the price that you originally agreed in the contract. So again, timing and pricing would differ, but obviously because you'd have a contract that says that. Okay, let's see. 2:15. Why don't we just, I'm not good at ending early, but The other class, I've just had so many technical problems, so why don't we stop there so I don't feel like I'm so far ahead of the other class with you guys? Okay, we're done.